Hello, everyone. Welcome back to the channel. Today, we have a special guest interview with Raj, who is the CEO of Evolve ETFs. For this interview, we'll cover a few of the popular ETFs and also the newly released ETF called SIXY. How are you doing, Raj? And welcome to the channel.
Thanks for having me. Doing great.
Nice. So let's kick things off. The first question I have here is just a bit more general, but I think it's something a lot of investors have come to notice about Evolve, and is how you've been able to be so consistent with your distributions. Each fund does it a bit differently, but it was a secret that your team has figured out.
It's a great question. What we when we talk to a lot of investors, advisors about what their preferences are for distributions, the most common response is they want some level of consistency and some level of predictability instead of variability every month. And so what we tend to do when we're coming up with our distribution amount is we take a look at what we feel based on the current market conditions that we could conservatively generate, and recognizing that there's going to be periods in there where you're not going to necessarily be able to generate that distribution, and other periods where you're able to generate even more than that. And so throughout an entire market cycle, what is that distribution amount that we feel comfortable with? And that's how we tend to come up with it. And then what we do is we fix it based on a certain distribution per share.
Next, let's get into some questions about BIGY. Actually came out not too long ago, back in September. And this
Mhm,
is your US equity ultra yield ETF, and it's currently an equal weight of 10 holdings. And
mhm,
it's basically the Meg 7 plus Palantir, Coinbase, and Strategy.
mhm.
And the ETF uses an actively managed cover call strategy with 33% leverage, and the distribution frequency is twice per month. So my question is, now that we've seen interest rates dropping in Canada, is the trend of 33% leverage going to replace 25% leverage? And is the distribution frequency at twice per month replacing the monthly distributions? And what are your thoughts on these changes as newer products are released?
Uh, yeah, lots of good questions there. Um, I wouldn't say that it's a pure function of, in terms of the leverage, that it's a pure function of interest rate cost. That's definitely one participant in it. The question that I do get asked often, which I think you're asking as well, is why 33% versus 25%? I gotta say it's a little bit of art and science. There's no specific reason other than we didn't want to go way too far the other route in terms of a lot of leverage. Like, we don't want to get into the double up or double down type of portfolios. We think that for us at least, that's not an area that we want to dive into. I'm sure your viewers have been able to see those, and I'm sure some of your viewers have used them, but that's not in our wheelhouse. So we wanted to add a little bit more leverage because we wanted to have a little bit more yield that was available to investors. And that's kind of why we went from 25 to 33. Also, what you would have noticed with the introduction of BIGY as well as CANY and now SIXY is that we have introduced a new lineup of funds, which is our Ultra Yield lineup, where we have a little more leverage, where we have a little more covered calls to generate hopefully a little bit more yield for investors. And that's kind of the strategy that we have with that new lineup. And so far, it's been going really well. And sorry,
Yeah,
you
for
asked
sure.
another question in the first part about distribution frequency. That was, moving to twice a month, and all of the other ones are monthly. That was a decision that we made, also kind of hearing from investors and advisors that they would prefer a higher frequency of distributions, cash flow. I think, some people look at it as, well, I get paid for in my job, I get a paycheck twice a month. I'd like my investments to be able to pay twice a month. We've also looked at doing weekly distributions, but the back end operational infrastructure in the industry just isn't there yet. But we're hoping that, in a certain period of time soon, we will be able to get there, or the industry will be there, and we may very well be moving to weekly. So what we did with all of our ultra yield prospectus funds is we gave ourselves the ability to increase the frequency of distributions if and when we get to weekly. And as you may or may not know, there are some funds, I believe, in the US that are actually even paying daily distributions. That might be a bit of a stretch, I don't have any expectations that we would get there, but you're definitely seeing, more frequency of distributions has become very palatable for the investor community.
Yeah, actually gets into some of the other questions I have, but there's also one thing I noticed on your website that you changed it from semi-monthly to twice per month. In terms of like wording wise, that's on purpose for sure, because I definitely saw it changed across the entire
Oh yeah,
website.
there's so many there's so many ways to, some people consider bi-monthly twice a month, but in actuality, that's once every 2 months.
Yeah.
Um, Bi-weekly is also not correct because bi-weekly would mean every other week. But if you've got 52 weeks in the year, that would equal 26 distributions being
Hmm.
paid. Semi-monthly or twice a month are basically the same thing. So semi-monthly or twice a month means that you're paying out twice a month, which means that you're paying out 24 times a year because there's 12 months in the year. So there's some slight nuance differences. We just wanted to be very clear with investors that it is twice a month
Okay.
distributions. I mean, I'll tell
Yeah.
you, a lot of people, including myself, if you'd asked me a couple of years ago, bi-monthly would have also kind of meant you could interpret it as twice a month, but in fact, it's once every 2 months. There's too
Yeah.
many complicated words in the English language, I find sometimes. Should make it a
Yeah,
little
I mean, I had to Google it a couple times too, just to make sure. But yeah, what you did there in terms of that change makes it very clear for investors that it's
I
definitely
think
twice a
so.
month.
Yeah, I think
Yeah.
so. I think saying twice a month versus semi-monthly, it's basically the same thing, but I think twice a month is just clearer.
Yeah. Yeah, for sure. Um, going on that, can you explain some of the differences between the covered call strategy or details when it comes to what you have typically done in the past, which is monthly distributions, and maybe what sort of changes to the products that um, things that you've done to the product in order to accommodate for these changes? So one of the things I noticed was that for BIGY, CANY, and SIXY, for instance, they all started at an inception price of $25, while
Yeah.
many of your previous ones like Bank, Oily, and Utes all started with a $10 price at inception. So is that due to the differences in strategy?
No, not really. It's interesting. We had seen in the past where some people would view, think about it in a typical retail product world. If you have the opportunity to buy something for $10 versus $25, you will often pick the $10 one because your view will be that it's cheaper, right?
Mhm.
But in our world, that's not true. Your cost is really your management fee that you're paying on the product and any charges that you have in terms of trading as well. And so we've kind of toggled between doing it at $10 versus $25, but there is no difference. I mean, if you invest $25 and you buy one share versus when it's priced at $25 versus if you invest $25 on a $10 NAV and buy 2.5 shares. I know you can't buy half shares, but let's just pretend that you can. It's the same thing. So there's really no big difference between a $10 price and a $25 price as it relates to that. You were asking in the question about covered call strategy. So a lot of our other funds in the covered call space. As you are probably aware, we typically would write on 33% of the portfolio with the ultra yield lineup. So BIGY, CANY, SEXY, six, SEXY. Won't
Nice
be the
slip
last
up.
time I make that mistake. BIGY, CANY, SIXY, we write on 50%. So we're writing on a little bit more of the portfolio. Also, oftentimes with the other products, let's call them the non-ultra yield covered call funds. We are typically writing slightly out of the money, so anywhere between 2 to 5% out of the money, and we're rolling on a monthly basis. Keeping in mind all of our covered call overlays for all of our covered call funds are actively managed as well, so that includes the ultra yield. So with the other covered call funds, you have less exposure to covered calls. You have potentially a little bit more upside potential because you're writing slightly out of the money. Whereas with the ultra yield lineup, you're writing on more. So instead of 33%, you're writing on 50%, and you're typically writing at the money as well, or very close to at the money. So what does that all mean? Well, what that means is for the non-ultra yield funds, you might end up with a lower yield, but also the potential for more upside participation. For the ultra yield portion, you could generate more yield because you're writing at the money and you're also writing on more of the portfolio. But it also means the trade-off is that you may not be getting the same upside participation as you would with the others. We decided that there was a big subset of investors that really wanted more yield, even if it was at the expense of some of the upside. So I always say to investors, there's never a free lunch. You need to understand what the advantages and disadvantages of covered calls are. Obviously, the advantage is that it can help you generate tax efficient yield. But the disadvantage is that you are giving up some of your upside growth potential in the portfolio. Another advantage is that it can help offset some of your losses by writing calls, obviously, because the premiums that you receive can offset some of the losses in the portfolio, assuming that the portfolio is going down. But let's be clear, it's not going to offset a lot of your losses. You're still going to have
Mhm.
pretty large participation on the downside as well. So it really depends on what your preference is. I would say that, if you don't want any of your upside potential compromised, then you probably shouldn't be using covered call funds because most times you will tend to, in an upward trending market, you will tend to underperform because of the amount that's covered. If you are looking for a healthy amount of upside potential with a little bit of yield, then maybe you want to have some portion covered, and then of course you go from there. If you want less upside potential, but you want more yield, then you want more coverage. I know I don't know if I'm making sense with all of that, but hopefully I'm giving you a bit of a kind of a spectrum of options that investors and obviously advisors have as well. And so, like I said, for the ultra yield lineup, we decided that we felt that we wanted to go a little bit more directed into more income generated for investors. And that's also why some of the stocks that are in this portfolio are there. You mentioned with BIGY, you obviously have some of the large S&P 500 companies in there, but then you have a few additions like Palantir, Coinbase, and Strategy as well. And part of the reason for that was, we felt like investors wanted some crypto or Bitcoin exposure, but also those stocks generate more option premium as well because there tends to be a little bit more volatility, which ultimately leads to potentially more income if you have higher option premiums.
Yeah, wow. I think that was probably a very, very, very complete answer and very clear as well.
Maybe too
So
complete. Yeah.
I'll
I
probably
just,
ask a
I
bit
do,
more about it
I always,
afterwards.
I just always feel like investors really need to understand both sides of the coin. In terms of covered call funds, like you need to understand what they are. If you are thinking that you're buying a covered call fund and you're getting X% yield and also full upside participation, you are incorrect. There is a give up in that process. So you, as the investor, need to figure out within your portfolio, what are your priorities? Are you looking for more yield at the expense of getting more upside capture or more upside participation? Then they make a ton of sense. But if you're just looking at, I just want upside capture or upside potential and participation, then maybe covered call funds are not the right funds for you.
Yeah, no, that's perfectly that's perfectly how I would explain it as well. Um, so going along that, in terms of like Biggie itself,
Mhm.
would you consider adding more stocks to Biggie in the future? And or is this kind of more where you're comfortable where the yield is? Because I know some of the other funds may be adding more volatile stocks into their ETFs now, just to increase the yield possibly. But what is your thoughts on that?
Um, yes. The answer is yes. No, I'm just kidding. We're always going to be looking at that. I mean, we do actively manage the portfolio, and not just the covered call overlay, but also the portfolio as well. And we are looking at whether we should be increasing the number of positions or even replacing some of the existing positions as well. Our portfolio management team meets on a very regular basis to kind of talk about that. I can't really tell you whether we are planning to increase or not. I can tell you that it's highly unlikely that we would decrease the number of positions that we currently have in the portfolio because right now we have 10. So more than likely, one of two things will take place. At some point, we may decide to replace some of the existing positions and or increase the number of positions. I know I have seen some people commenting that they would prefer a more diversified portfolio, i.e., more positions in the portfolio. So, we are keeping that under consideration. Oftentimes, when we've done analysis of performance of baskets, we have found that smaller baskets tend to perform better than broader baskets. I mean, think about the S&P 500. It's a great example, right? If you took the top 10 stocks of the S&P 500 over the last few years and just owned that versus owning the S&P 500 itself, you would have done way better. I'm sure investors can use ChatGPT to look that number up, but I mean, as many people know, for example, the Mag 7 have driven so much of the market returns, not just for the S&P 500, but also for the Nasdaq, for example, over the last 5, 10 years. So sometimes a concentrated basket makes more sense, and sometimes it doesn't. But for now, we really like the concentrated portfolio, but that could change in time.
Nice. Um, so what are the requirements maybe to could be considered to be added to BIGY?
So with BIGY, what we did was is we took a look at the 25 largest market cap stocks in the S&P 500, and that was our starting universe. And then out of those 25, we took a look at which eight, seven, eight of them could generate the most option premiums attached to it. And then we manually added in, as you noted earlier, we manually added in strategy as well as Coinbase in there as well to generate a little bit more option premium and to give investors some Bitcoin exposure. So, I couldn't tell you which other stocks we'd be looking at, but we typically have used that 25 largest stocks on the S&P 500 to kind of be our guiding post or our parameters to start.
And then also along the lines of holdings again, would you like you already mentioned you would consider replacing some holdings? So for example, like MSTR was seeing lower volatility in the summer months. It's
Mhm.
picked back up a little bit now, but if it had continued to drop, would you have considered replacing it?
We might. I mean, I can't really comment too much on that because really,
Yeah.
that's my portfolio. That's our portfolio management team that's making that call. I try not to get too involved and provide my opinion in there. I think that our portfolio management team is very strong and very capable, and so we kind of leave it to them to make decisions. But I don't sit on the portfolio management team. If you ever want to interview one of our portfolio managers, I'm sure that team would be happy to come on here. But yeah, I would leave that with them. They're the experts.
And then my last question for Biggie, just in general here for Biggie, is the semi-monthly distributions. How soon do you think we can see the weekly ones? Just because you already mentioned it in the prospectus.
That's semi-monthly, twice a month.
So,
I'm just
yeah,
kidding.
sorry.
It's the same thing. It depends on the operational infrastructure. It's really not up to us, to be honest with you. There's a lot of back-end plumbing that's involved in running ETFs and operating ETFs. And right now, the back-end plumbing involved in it cannot facilitate weekly distributions. We've had a number of conversations with those service providers. We have been told they're making progress, but I don't have a timeline as to when that will be. I'm hopeful that it's sometime, not to give you too wide of a parameter, but I'm hopeful that it's sometime in 2026.
Yeah. Just a follow up on that as well. Because there are a lot of newer funds being released right now, they're all semi-monthly or twice a month. Um, Do you think you would see all of them switch at the same time to weekly once it becomes available, or is that more of a gradual thing or like a fund by fund decision basis?
I think, ETFs are democratic instruments, right? And if investors are telling the fund companies that they really want weekly distributions, then I think a lot of people will switch to it. I can't speak for what my peers' plans are going to be, but if they're listening to the market, then a lot of them probably will switch to weekly. The question will become whether they built the flexibility into their prospectus to be able to actually distribute more than whatever their current distribution parameters are. I know that I've looked at some prospectuses that actually say it's very etched in stone where they're paying out monthly. So they would have to go through an entire regulatory process, including a unit holder vote or shareholder vote, in order to move it to, let's say, a twice a month or a weekly. So they'd have to be very confident that it's going to be a significantly positive change to their funds to undergo that regulatory process, which is why, as I said, with our ultra yield lineup, the way we built our prospectuses, we gave ourselves the flexibility to increase the amount of frequency. But I believe there's a lot of other prospectuses out there that don't have that flexibility. So maybe what you'll see more than anything else is you'll see a lot of new funds that come to market that are focused on paying out distributions, perhaps go to weekly, or perhaps use similar wording to what we used, which is, go with whatever the maximum frequency is today and give yourself the flexibility to become more frequent down the road.
Now we're going to switch over to one of your other popular ETFs that a lot of people hold, and we'll go talk about bank. So
Mhm.
this is one that's been around for a while, or seems like a long time ago now, back in February 2022. So that's like 3 years ago. It's your Canadian Banks
Almost
and Life
four.
Goes
Guess we're
ETF.
coming up to our 4-year anniversary soon. Yeah, sorry.
Yeah, yeah. It's your Canadian Banks and Life Goes ETF, which holds all the big six banks and four life cos equally weighted. It's actively managed cover call strategy with 25% leverage and a monthly distribution. I think one of the great things about this is that the ETF underlying holdings all pay a distribution or pay dividends, and it's also a growing dividend every year. So for bank, I was wondering how much of this natural growth in the dividend helps in terms of the distribution increases over time uh, that you've had it.
Yeah, it definitely helps. I mean, you have a couple components that go into the distributions that you're paying, and in these funds specifically, and it's the dividend of the underlying portfolio and the call premiums, the option premiums that you're paying out. And so as your dividend increases, it makes paying out those distributions usually a little bit easier because it gives you more distributions. So for sure. You just saw last week the Canadian banks reported, and I think every single one of them, or almost all of them, hiked their dividends as well. So that usually is a positive thing from an income perspective for dividend investors as well as overall investors in the Canadian banks from a cash flow perspective.
Yeah, I just think it's a very clever way of leveraging both the cover call premiums and also the natural growth with the dividend included together for the returns.
Yeah.
So, with over three, almost 4 years of history now, what would be your reflection or evaluation of bank as a product from when you first launched it?
I did not expect it to resonate as much as it has in the marketplace. And part of the reason is that there's quite a bit of Canadian financial ETFs that are in the market. And I never really thought that, people would look at us as a product destination, I guess. For it. I knew that the opportunity set was big, but I also felt like there was a lot of product already that was in that space. And I when I started Evolve 8.5 years ago, I was always very focused on finding the blank space in the industry, meaning finding opportunities around products that are not in the marketplace as well. And, you learn a few lessons from that. Sometimes it's great to be first, but what if you're first on something that nobody really likes or nobody
Yeah, you're
uses,
ahead of the
right?
times.
So you have to be really careful. And then other times, the investment community rewards you for taking a look at what is out already in the market and being able to add a little twist to it to hopefully make it a little bit better. And I think we kind of captured that with bank because we again we had kind of a small portfolio of the big six banks and four life cos, and we had obviously some covered calls and up to 33%, and then we added some leverage to it as well, and then the whole kind of recipe kind of worked from an investor interest perspective as well. And so, I mean, look at this year, for example. This year, I believe we started that fund started with 343 million at the beginning of this year, or we were at, and now we're kissing 800. I mean, it is our largest covered call fund in our entire lineup and has also been our best-selling covered call fund this year as well. And so I would not have expected it because I wouldn't have thought of people looking at us as a banks or a financials. But I'm obviously very glad that
Yeah.
they have, and I think that the product has served investors well. So I think it's been a very symbiotic relationship. But I think one of the things that I've been doing a little bit more of in this business is taking a look at the landscape and the environment that we're in, taking a look at some of the products, and then seeing if I can add a little twist to make it a little more interesting from my perspective and hopefully from the investor's perspective. And that's where, my best example of that is QQQT. And that is a NASDAQ technology fund. And I'll just tell you really
Mhm.
quickly about it because it illustrates the example really well. So a lot of investors, when they want to increase their exposure to technology, what they do is they go and buy the Qs or they go and buy any other NASDAQ 100 ETF. What they don't often know is that a big portion of the NASDAQ 100 portfolio is not technology companies.
Yeah.
So when the NASDAQ 100 started in 1985, it was started to be purely a non-financials index. Technology barely existed. Technology companies barely existed in 1985. But because of the exclusion of financial services companies, it became a more and more tech-heavy index over time as you had more and more tech companies go public and grow and perform well. And somehow in the last 10 years, everyone viewed the Qs or the NASDAQ 100 as their go-to for technology. But when you invest in the NASDAQ 100, you're also buying Pepsi, Marriott, Costco,
Costco. Yeah.
Lululemon, Starbucks. So a lot of non-tech. In fact, roughly about 50-60% of the names in the NASDAQ 100 are non-technology companies. They make up about 40% of the market cap. And so we came up with this idea. I was actually having lunch with the NASDAQ. We were talking about it. And I said, wouldn't it be interesting to give investors what they thought they were getting in the first place when they were buying the NASDAQ 100, which is just the technology component of the NASDAQ 100? And they were like, we love that idea. We've been running a live index. We'll send you the data. They sent me the data. The data was obviously the performance was fantastic, the historic performance, and so we partnered up. And so that's a great example of taking a look at something that is in the marketplace that is somewhat mainstream, being the Nasdaq 100 is typically a big portion of a lot of investors' portfolios, but trying to put a little twist to it to hopefully make it a little bit better. And I think we've had some pretty good success applying that type of strategy to a number of ETFs in the marketplace.
Yeah, I've
Long
seen the
answer, I know.
performance
Sorry.
on that. No, that's a really good answer. I've seen the performance on QQQT, and it's actually really impressive in terms of how it's performed so far. And it kind of goes
Mhm.
with what you said in terms of how it's just the technology that is how performed. in
Yeah.
that sense. So how much of the influence or performance from bank kind of informed your decision to create SIXY?
Yeah, I mean, I think we kind of touched on it a little bit. As I mentioned, we started this year in bank at just over 340 million. We're kissing 800 million. It's been our best-selling covered call fund. It's been one of our best-selling funds, period. Within our lineup, as you know, we currently manage just over almost 8.5 billion, just over 8.4 billion in assets today. So that fund has become a very important component of our lineup. And so when we looked at, oftentimes, sometimes what you have to do is not just look at what you can look at in the industry and make changes to it and potentially make it a little bit better, but sometimes what investors are looking for within your lineup as well, and can you deliver it in a way that potentially doesn't cannibalize your existing funds. And so when we looked at bank, we felt like there's still a big subset of investors that really just wanted concentrated bank exposure. I believe there's about $16 billion right now in Canadian financials ETFs. But
Hmm.
of that 16 billion, about 10 billion of it is just specifically in Canadian bank ETFs. So there's a large subset of investors that just want to have pure exposure to banks and don't want it to be diluted by life cos. And so we decided we wanted to deliver that type of portfolio to investors where it's just concentrated around the banks. And that's why we came up with the idea of 60. And then, of course, there's a lot of other differences with bank besides the life cos, which we already touched on, right? I
Yeah.
mean, you have a little more leverage than bank. You have more coverage, covered calls than bank. You obviously have a more concentrated portfolio, and you also have distributions twice a month as well. So there's a few other differences that are there. But yeah, so far the launch has been going pretty well. I think it's only been a week.
In terms of like maybe just quickly summarizing, I know you already went through the strategies and stuff, but maybe just for a quick like 2 minute summary of maybe what the differences would be for bank and SIXY, and how would you help investors decide which one they would go with?
Well, I would never give any advice to an investor. They have to figure that stuff
Yeah.
out themselves. You have a lot of tools online, obviously, that can help you, and obviously the company websites to get more educated on how these products work so that you can make an informed decision. But yeah, so let's go through it. So here's bank. You've got the six banks, four life cos. 60, just the six banks. Okay, so that's
Yeah.
difference number one. Difference number two, bank. You've got 33% covered calls, and 60, you've got 50% covered calls. And also, um, uh, you're writing typically at the money, whereas with bank, you're writing slightly out of the money. So more coverage, more covered calls with 60. Uh, Bank, you have 25% leverage. 60, you have 33% leverage. Bank, you have distributions being paid once per month. 60, you have distributions being paid twice per month. So those would be the highlight differences between the two funds.
And in terms of like a more fun question,
Mhm.
um, for SIXY, I was just wondering who came up with the ticker SIXY, and did you have sort of like a brainstorming session just for the ticker selection of this?
I take a lot of pride in our tickers. I think we've come up with some great ones. I've been shocked that some of these tickers have been available, like Bond. We launched a US Treasury with covered calls a couple of years ago, and we were shocked to find that Bond was available. We've been fortunate because when we started our business 8.5 years ago, it was just after the introduction of four-letter tickers. Because up until then, it was only you could only use three-letter tickers. So as you can imagine, there are many, many more words you can come up with four letters than you can with three. So our timing was really good in terms of four-letter tickers becoming available. We always try to um, we always try to come up with a ticker that it highly represents the strategy of the fund as well, and preferably a word.
Yeah.
Um, you can't always come up with a good four-letter word that describes the fund, but I think we've done a pretty good job. You know, that sometimes the internal joke that we have in the office is let's come up with the ticker first and then come up with the product idea. But that wouldn't make a ton of sense. So, you know, SIXY was my idea when we were thinking of different tickers. And because the ultra yield, you'll notice that all of the ultra yield tickers end with a Y. So
Mhm.
BIGY, CANY, and now SIXY. And I like SIXY because it's obviously the six banks. We wanted it to end with a Y, and you know, it's kind of sexy. And not that you could call the Canadian bank sexy, and it's probably a bit of a stretch. Um, but I kind of liked it. But yeah, I mean, I would say um, some of my favorite tickers that we've come up with, Life, which is for our global healthcare fund, Bond,
Mhm.
as I mentioned already, Cyber, which actually isn't a word, but it's for our cybersecurity ETF. It's CYBR. So I think we've been pretty good with our tickers. My favorite ticker that I remember I came up with on a flight, I think to Calgary, either coming back from Calgary or going to Calgary, is Hero,
Oh yeah.
because it's a ticker for our e-gaming ETF. And the objective when you're playing a video game is to always be the winner or the hero. And so I love that. I love that ticker. In fact, I think that somebody in the US copied it for their fund because we came out first. So I can only conclude that somebody used the same ticker in the US. They came up with the same idea or saw ours. So yeah, we do brainstorm a lot about it. We come up with a lot of different ideas. We go and reserve a lot of different tickers, and then we determine which one as well. You know, for example, we launched one of our tickers that we came up with that a lot of people in the office did not like um, was Oily,
Oh
which was
yeah.
like which is our energy yield fund. A lot of people kind of associated oily with greasy or something like that, but
Yeah.
we still used oily.
Yeah.
So, you know, you can't win them all. Some people don't like that ticker. They still don't like that in the house. You can't win them all, but I think for the most part, we've done a pretty good job of our ticker creativity.
Yeah, I think in general, most people are pretty in favor of the oily ticker. They like it. It represents the ETF very well, right?
Catchy, right? I think I think if it's memorable, like instead of like an I don't know XPTR or some just making up a ticker that means kind of nothing. I like a word. It's easy to remember. I mean, 60 is not a word, obviously,
Yeah.
but I like it to sound like words, even if you can't come up with the perfect spelling of words, and it's just easy to remember.
Is that why you also had to change the canny one? Because it used to be maple, right?
Yes, actually, that's good catch. Um, we never ch we changed it between our preliminary filing and our
Yeah.
final. So
Yeah.
and we never launched the fund with Maple. Um, I had too many people calling it Maple
Uh,
because it was MAPL.
yeah.
And obviously that's not how you spell maple. And too many people were calling it maple, and I was like, this sounds a little bit like apple. And maybe people aren't realizing that it's pronounced maple. So we just decided to go back to the let's stick with this Y at the end
Yeah.
of all of our ultra yield, and it's Canadian and it's yield. So let's go with Canny. And Biggie
Yeah.
was, big US stocks with yield, so it's biggie. So I think in retrospect, it was a good idea, especially because, like I said, a bunch of people actually started calling him Apple, and that's not what the intention was.
Yeah. Yeah. And then we also have INTY coming out too, which I think is
Yeah,
also a good one as well.
with a Y,
Nice.
international yield.
Yeah.
Yeah, I mean, pretty self-explanatory.
Yeah. Yeah. Okay, so I just have a few more questions, more related to sort of the future. So we've all seen in 2025 that it's been a really exciting year for covered call ETFs. So I was wondering, from what I can see anyways, there's been at least 88 new covered call ETFs this year. So did you expect this much action going into the year? And what's your take with how quickly it's been growing this past year?
As long as the appetite continues to be strong, then you will continue to see more product come to market. It's pretty simple. Yeah, this year there was a lot. I think that there's about $35 billion now in covered call funds in Canada. And so that number has grown quite a bit in the last few years. We've seen a lot of flow go, us and others have seen a lot of flow go into them. So it's going to be purely a function of appetite. I mean, you have demand, you have supply. If demand continues to grow, then you end up increasing your overall supply to hopefully find that market
Yeah.
equilibrium, right? So it's really just going to be a function of that. I mean, the DIY community appetite for covered call funds or yield generating funds has been incredible the last couple of years. And so as long as that continues, then I continue to see more iterations. And sometimes people will say, well, there's so many products, it becomes confusing. I agree, it can become confusing, but I'm all about more choices. The more choice you have, the better options you've got. It does require you to do more homework, of course, and watch shows like this and some of the others out there to get properly educated. But imagine if you only had one option. That would kind of suck and probably not be ideal. So I think, investors here have a ton of options in terms of covered call funds tied to all the different asset classes out there, all the different sectors as well. I mean, think about it. You've got covered calls tied to large cap Canadian equities, large cap US equities. You've got it tied to US treasuries. You've got it tied to other bonds, to Canadian bonds. You've got banks, you've got life cos, you've got materials and mining, you've got pretty much everything under the sun.
Yeah.
So I think the way, investors in general should do it is they should pick first what sector or what market they want to invest in terms of what equity basket they want to invest in, and then take a look at what the coverage ratios are if they're going to buy covered call funds, what covered call percentage you have, is there leverage, do you feel comfortable with that, what the management fees are, what the total cost of ownership is of the funds, all that kind of stuff, and then make an informed decision.
Yeah, I think Evolve also has a good product line for that too, because you always cover different sectors within the Canadian landscape. And it's like you said, just pick what sector you are interested in and do some more research on that.
Yeah,
So,
exactly.
yeah. So for 2026, do you think we're going to see the same amount of growth, or do you think we're going to see more?
You know, as I always say, nobody has a crystal ball that works properly. They all have cracks. Some crystal balls have more cracks in them than others. So I really don't know. I think it's going to be a function of the market. What are we going to have a healthy market next year, or not? Are we gonna have investors and advisors continue to have this appetite for yield, tax efficient yield? As well. Do we end up in a market correction? I don't know.
Mhm.
Where are we going to go with rates? Where are we going to go politically in the US? I mean, there's so many wild cards. The ultimate wild card always is a war because those are very difficult to predict and what the impact is on the economies and the markets as well. So way too many variables for me to kind of tell you whether, but here's what I will tell you. If 2026 is like 2025, then you will have more growth in covered call funds, and you will most likely have more covered call funds coming to market. But very rarely do years repeat themselves, right? I mean,
Yeah.
I'll give you a great example. At the beginning of this year, when there was all the talk about the tariffs in Canada,
Hmm.
did you ever think that the Canadian market would perform as well as it has? Did you ever think that the Canadian market, the TSX 60, would outperform the S&P 500 this year or outperform the NASDAQ 100?
Yeah. No
Well,
one
here we
probably
are.
saw that,
I
right?
mean, the year's not over. We've still got a few more weeks, but here we are, right? The Canadian market has been incredible. this year. And I can tell you, I would have never predicted that. And any person that I talk to about it says the same thing. They would have never been able to predict it. A couple of people would have said, yes, but I knew that gold was going to do really well, and Canada's a gold heavy market and stuff. But I mean, I still think for the most part, like 99% of investors out there would have never predicted that the TSX 60, the Toronto Stock Exchange 60, would have had the kind of year that it's had this year. So I think you
Yeah,
gotta, just think about the world in the long term.
yeah, definitely. And with that answer, I think that perfectly wraps up all the questions that I have. Is there anything else you would like to add or maybe ask the audience?
No, I think we did a pretty comprehensive interview there.
Yeah, I've seen a lot of your interviews in the past, and I can say you're a very good person to interview.
Thank you.
Your answers are
I,
very
I
concise and very clear.
well, I think you need to be transparent. I think you also need to make sure that people understand that there's no free lunch, that there's downsides, there's upsides, and there's downsides, and they just need to be educated before they make decisions on anything. Because I wouldn't want people to be investing in these types of products assuming that it's all rainbows and unicorns, right?
Yeah,
I
for
always
sure.
say there's rainbows, but there's a lot of rain to travel through that rainbow sometimes. So I think you just need to be you just need to make sure that you have a balanced view on things and have realistic expectations as well.
Yeah. Okay. Awesome. All right. Thanks, Raj, for your time and the opportunity to chat. I think you're probably busy with year end coming, so all the best to your team and closing out the year.
Thank you
And I
very
hope
much.
to
Thanks
help
for
you.
your time, and thanks to all of your viewers for all their support this year as well.
Yeah, hope to have you back on the channel again sometime soon.
For sure.
Awesome. Thank you.
Okay.